at the end of the year would cost 20 bucks. Okay, so it's serious. I'm talking about real hardcore inflation, not 10% a year. I'm talking about 2,000% a year. The Brazilians were forced to link their debt to the IPCA, which is an index of inflation, and that way the creditors were protected. We have already started doing that. We do that with something called TIPS, Treasury Inflation Protected Securities, but it's a scam in my view. Right? TIPS are tied to CPI. CPI is probably the most heavily manipulated government statistic in the world, and this is the ultimate case of the fox guarding the henhouse. The government's saying, hey, trust me, I'm going to calculate CPI, and I'm going to pay you for CPI. It sounds great on paper, but it doesn't really play out in reality. CPI is calculated by the Bureau of Labor Statistics. It is showing an annual rate of inflation right now of about 1% per year. There is a fantastic website out there called shadowstats.com. It's run by a guy named John Williams. And if you go to that website, have you been to that website?
I know John Williams.
You know John Williams?
Or no, I know of him. I've heard of him.
I've heard of him.
You've heard of him. What John Williams does is he uses the same data that BLS publishes, Bureau of Labor Statistics, which is a government agency. I think it's part of the Department of Commerce. He uses the same data from BLS. He uses the formulae that BLS used to calculate CPI back in the early 90s before they started meddling with CPI too much. And according to his calculations, and again, it's nothing proprietary, he just uses BLS's data and their old formula, inflation is actually running at around 8 or 9%. That's the real rate of inflation right now. Sooner or later, our foreign creditors are going to catch up. They're going to catch on to our shenanigans, and they might buy tips. They might, however, insist that the rate of inflation not be CPI. They might insist that a guy like John Williams calculates it. Right? It's an independent third party. You could also avoid the dollar altogether. It would not surprise me in the least to see foreign currency denominated U.S. Treasury bonds. Okay, and again, we have precedent for this. Our creditors might say, we're not going to loan you money in dollars. We're going to loan you money in euros or yen or yuan or some other currency, maybe even in gold. During the last bout of inflation in this country in the 1970s, we issued something called Carter bonds, named after Jimmy Carter. They were U.S. Treasury bonds that were denominated in Swiss francs and German marks. And we did this because those two countries in particular were concerned that we were going to inflate away our debt. It wouldn't surprise me. I think there's a good chance we're going to see foreign denominated U.S. Treasury bonds at some point in the future, if we don't clean up our act. The scenarios are not pretty. Bottom line scenarios are not pretty. If things get bad enough, it would not surprise me to see capital controls in this country. They've been most recently and most famously tried out in Malaysia, which guess who loves capital controls and who was in Malaysia at the time? Paul Krugman. We have been the beneficiaries of capital flows from the rest of the world for about 30 or 40 years. When a private company wants to sell its goods to a customer and the customer can't afford to pay cash, the company, the vendor, the seller, will sometimes offer to loan the customer money so that the customer can afford to pay for the seller's goods. This is known as vendor financing. What we have had in this country for about 30 or 40 years is effectively the largest vendor financing scheme in history. Right? It's trillions and trillions of dollars. What has happened is we have not been able to afford all these imports. I mean, I drive a Chinese car, I drive a Japanese car, I drive a Honda. We have been feasting on imports, excuse me, for literally 30 or 40 years. The way it works is we send our importers import products, right? We give them dollars. they accept the dollars, they turn around and they deposit the money in the US Treasury. And so the money is actually sitting here, right? They make profits and they repatriate the profits back in the United States. So they've been effectively, we've been borrowing money, they've been lending it to us, and then we turn around and we use the money that they lent to us to turn around and buy their products. And then they take that money and they go invest it in treasury bonds. All those treasury bonds that foreigners own are actually on deposit at the Federal Reserve inside the United States. So what capital controls would do would be to effectively trap that money excuse me, in the United States while we inflate away our debt. I mean, it would not surprise me to see the Federal Reserve come out in conjunction with probably the Treasury Department and say, hey, it's a dangerous world out there, it's very risky, and the United States is the safest country in the world. So what we're going to do is we're going to hold your bonds here. You don't have to, we're not really going to let you sell them, we're going to just kind of hang on to them for you. We're going to keep paying you interest, and of course the capital is trapped in the country, and we can inflate away our debts. That would not surprise me in the least. We don't even have to go that far, by the way. There's something called a Tobin tax, which is effectively a tax on foreign currency transactions, right? So maybe you're China, or you're Japan, or you're Europe, or some of the oil exporting countries, and you're holding a bunch of treasury bonds. They're sitting at the Federal Reserve, which turns out in hindsight to be a bit of a mistake because you don't have them. You can't just sell them on the open market. So a Tobin tax is basically a tax on foreign currency translations. So what the Federal Reserve or the Treasury Department might come out and do, probably the Treasury, is say, okay, you can get your bonds out of the country. You can sell your bonds and get your dollars out of the country, but we're going to tax that translation. Okay, so you can get the euros, you can get the yuan, you can get the yen, but we're going to implement a 10% tax, and in effect it devalues the value of the US dollar by 10%. If you think about it right now, let's take a simple example like the Canadian dollar, right? Right now the Canadian dollar is roughly 1-to-1 to the US dollar, right? With $1, you can get about $1.02 Canadian. But if they implement a Tobin tax, say of 10%, then with your $1 US, and when you try to translate that into Canadian dollars, what they might do is say, okay, we're going to take 10 cents as a Tobin tax, it's just a tax that goes into the US Treasury, and with the other 90 cents, you can convert that into Canadian dollars. So even if the exchange rate stays the same, I think it'll weaken, but let's say it stays the same, that means that now for $1 US, you lose 10 cents to the tax, and you translate the 90 US cents into 90 Canadian cents. So again, the effective exchange rate has been declined. Your $1 US, because of the tax, is now only worth 90 Canadian cents. Whether it's capital controls, or Tobin taxes, or inflation, or some mix of all those three, this is where I think we're headed, because no one wants to cut spending. Excuse me. So, you know, the end game to this whole thing is the loss of the reserve currency status of the US dollar. The reason that the rest of the world has put up with all these shenanigans that we've been employing so far is because the dollar is the world's reserve currency at present. I think that that's going to change, right? Right now, about 60% of the world's central bank, or 60% of the reserves that are held by the world's central banks are held in dollars. But the US economy only represents about 20% of global GDP. So that is basically a huge excess store of dollars that is being held on behalf of central banks. And those dollars are being inflated away. The reason that all these central banks are holding dollars is because trade and commodities are all priced in dollars, right? Oil, which is probably the most important commodity in the world, is priced in dollars. So, you know, if you look right now, Saudi Arabia is the largest oil exporter in the world, the ¡1 energy consumer in the world, and Saudi Arabia's #1 customer is not the United States. It is who? China. You got it. So the #1 exporter in the world of the most important commodity in the world trades with